Hello, can you hear me? Yes. Good. So I think we're really worried about this global volatility we see. The latest is the banks in the US. So, and it is particularly strange because after the global financial crisis, Rakesh Mohan calls it the North Atlantic, North Atlantic financial crisis, regulations were tightened worldwide for banks. But I think advanced economies still emphasized self-regulation, own assessment of risks. And after President Trump came in 2018, regulations were lightened for small banks. The recent Barr report of the Fed says that there was pressure on staff to reduce burdens on firms, to demonstrate due process and accumulate more evidence before action. So regulations were lightened for small banks. If there had been adequate capital adequacy, etc., then maybe SVB would not have collapsed. If there had been an exposure limit, it would not have collapsed. So, but then this was banks. But then we have non-bank financial intermediaries, and there is hardly any regulation there in advanced economies, especially on the entity side. It's on the borrower side, whatever there is. And these are the current source of cross-border volatility to emerging markets, and as global risk rises and so on. And emerging markets themselves fear that more regulation would increase finance costs. But it is the higher risk and volatility that raises costs. The interesting thing is that American macroeconomists under quantitative easing all wanted macroprudential regulations. For example, there was Janet Yellen has called for minimum margin requirements on a market-wide basis because they thought this was essential to regulate volatility under quantitative easing as liquidity rose. But in a recent talk with Krugman, she was regretting that they still don't have rules to prevent risky lending. So the US has very few measures to moderate credit supply. But emerging markets have much more of prudential regulation. There are exposure limits for banks, etc. And I think that the globe as a whole, we need some minimum set of macroprudential measures as universal criteria across countries and institutions also, because then these kind of arbitrage flows would be preserved. Earlier, cross-border flows came from banks, now they come from non-bank financial institutions. And these sort of regulation and tax issues were discussed earlier in G20, but it was decided that taxation and regulation should be an individual right. But after that, G20 has moved forward and they've been able to agree on a minimum corporate tax under the base erosion and profit shifting, preventing base erosion and profit shifting initiative. So in my view, G20 can be most productive in the provision of such collective goods where coordination of across countries is required. Because one country tightening alone can see capital flight. So G20 can actually strengthen the hands of regulators against domestic lobbies and political pressures, as we saw in the Trump era in the US, that create domestic risks and costly crises that lead to global spillovers. For example, in India, we are seeing IT companies slowing because they're not getting business from US banks. A lot of banks are under pressure, and all the three have already failed. And so it creates global spillovers. So I think I'll stop there.
Yeah, Mr. Pak, we can go with you.
Great. So I think one thing that's encouraging about the banking turmoil in the US is that it doesn't look like it's directly affecting Asia or emerging markets. And that's partly because banks in Asia don't have much direct exposure to the banks that have failed. Also, as was mentioned, banks in Asia tend to be well capitalized. If you look at what the market has said about the equity value of banks, from March 1st to May 8th, the bank equity index in the US has fallen 22%. It's fallen 7% in Europe, and it's actually increased by 1% in Asia, which is a vote of confidence. That said, with the most recent failure of First Republic, it does seem like it's a slow-moving crisis, and we're not really sure if or when it's going to end. And there certainly are scenarios where it could blow up and become a much more bigger banking crisis for the U.S. And if that's the case, we've been doing some scenario analysis of what that would mean for developing Asia. And so we estimate if there were banking crises that were about half as serious as the great financial crisis, it would reduce growth by about 0.5% in the US this year and 1.5% next year. And that would translate to just 0.25% decreased growth in Asia this year. and so it would affect, it would just reduce growth in Asia by 0.25% this year and 0.5% next year. So it wouldn't really detract that much from our baseline projection that developing Asia will grow by 4.8% this year and next year. But what are the lessons from the banking crisis? One thing I think is that it was certainly a failure of prudential regulation, that the interest rate increase scenarios were not properly stress tested to understand the real fragility. The other thing we learned is that it was really important to very quickly restore confidence, because with social media and digital banking, money moves very quickly. So depositors can take their money out very fast, and so the bank had to step in. And in fact, the US banking authorities had to guarantee all the deposits of the banks in question to restore confidence. And it raises questions for the rules in other countries, because people said that if it happened in Europe, they wouldn't have the right to do this blanket deposit authority, and so contagion could have been much worse. And so I think banks in Asia need to take account of that. The other thing we realize is that there's always this trade-off between moral hazard. You don't want to always bail banks out because you have a moral hazard problem, but it looks like that's what happens in most cases. They just get bailed out. Or if the bank regulator can get another bank to buy the bank or merge, then that's usually a much better solution. But if we're going to have these we're going to have moral hazard problems. If we're going to have moral hazard problems, it means we need to do even better on prudential financial regulation. So we really have to work hard to anticipate the different types of financial instability scenarios. Let me stop there. We're just going around.
I don't know. I don't know how to step in that. So let me start as if nothing had happened. This was right. Okay, but let me thank at the outset. Let me thank ORF and Samir for organizing this wonderful conference and inviting me to moderate this session. I don't think I've ever been late to moderate a session, because none of the sessions in India actually start before time. This must be a first. So I am sort of at an institution now. I used to be at ICRIER, but I'm at an institution now called the Shivnadar Institution of Education, or Excellence, sorry. It's a university, and the reason I'm saying this is because there is a history department in the School of Humanities and Social Sciences that I represent, and there are a lot of economists in the history department that write economic history. We also have historians writing or rewriting history, but we have economists who are writing history of financial crises. And there is a book, I remember when I was a grad student, there was a book by Kindleberger, which has now been, and I recommend it to everybody here. Kindleberger has been updated now. There's a new, I think, 16th or 17th edition to incorporate what happened in 2007 and 8. So it's sort of up to date with financial crisis. And there's this amazing sort of frequency and rapidity with which financial crises occur. Whether, as Albert said, it's due to lack of macro financial regulation or greed or trust or opacity, whatever it is, there is there are two features that stand out in that book. One is leverage, and one is opacity or trust. These are two factors that they identify as being the reason for a number of the banking or financial crises. And we saw so when I was in ICRIER, we were doing a lot of work in the G20, and one of the things that was particularly important for India, and Rakesh is here, what the spillover effects, and Albert referred to it, how can you prevent the spillover effects of loose monetary policy or quantitative easing on emerging markets like India? We had the taper tantrums, and there was a recognition in India at that time that we've learned from the depression, Great Depression, we've learned from the financial crisis, and we can sort of buffer ourselves, or we can firewall ourselves so that we don't get affected. In fact, I remember, when the Asian financial crisis happened and India wasn't affected, we were patting ourselves on the back and saying that, look, we were right when we didn't have capital account convertibility. And someone said, I don't know whether it was Rakesh or somebody, said that, no, not you. Somebody said, I think it was Sujit, who said, well, I mean, I'll give up capital account closeness, or rather have capital account convertibility and $10,000 per capita income, rather than a closed capital account and $1,200 or $1,500 per capita income. So, those were the kind of, and there's still those sort of trade-offs, or that narrative still exists in India. Another narrative, and I'll stop here, which became fairly popular during the financial crisis, was the surplus liquidity of China being a cause of the global financial crisis. And a lot of people in China and a lot of people in emerging markets were wondering whether the financial sort of crisis was a result of this liquidity, or due to the bad lending practices, or the overstretched lending practices to the subprime housing market, which subsequently went bust. So, I mean, these are, the reason I said history is because rewriting history or learning from history, if you don't learn from it, you repeat it. So the questions that I'm going to pose to this panel, and in no order, Albert is, so maybe Ashima, I'll go to you first, is sort of the G20 had a major role to play in the 2008-9 crisis in sort of stemming. It's the only reasonable success of the G20, I guess. So do you think the G20 can step in again?
Yeah, I was just saying that G20 is really important, where countries can coordinate and agree on something. So what happened in the US, where all the latest volatility is originating, is that regulations, prudential regulations on small banks were reduced. And nothing very much was actually imposed on non-bank financial intermediaries, which are the ones that are responsible for cross-border flows. And the reason was political pressures, the belief that regulation raises costs, but it's actually the volatility that raises costs. So if there can be a global agreement, if G20, if the major countries can agree that we need to impose some minimum capital adequacy on banks, some minimum market-wide margin requirements, that would reduce volatility, reduce risk-taking, and make the world a safer place. And I think that is a major thing G20 can do. In fact, G20 would be supporting the domestic regulators in many countries, in the major G20 countries, who can't withstand political pressure. Suppose Trump is voted back again, what would happen to the US financial system?
I'm sorry, I assume everybody knows Ashima. So Ashima is Professor Emerita at the Indira Gandhi Institute of Development Research, besides holding a number of other positions, including in the Prime Minister's Economic Advisory Council. Let me go to Miguel Iglesias, who's a senior analyst at the Elcano Royal Institute and professor at IE School of Global and Global Public Affairs, Spain. Miguel, the same question, if I could ask you from the context of Europe, is what do you think the G20 can do going forward in trying to prevent this, as Ashima said, these sort of smaller, which are not regulated, smaller financial entities that are not regulated. Can the G20 do anything to stem future crises?
Thanks, and it's really great to be here. Well, I'm kind of a political economist, historian of financial crises too. I do a lot of work on the geopolitics of money, and I think one thing that needs to be said is that we have a structural flaw in our international monetary system, which falls back to history and something called the Triffin dilemma. Robert Triffin, already in the 60s, said that the United States, by providing the lifeblood of the world economy, which is the reserve currency, the dollar, many times will be faced with a dilemma, whether it should look at domestic issues and how it does its monetary policy because of domestic reasons, and how it should provide liquidity to the world through the dollar, right? And this led to what were called dollar shocks. The creation of the euro, actually, as now the second most important reserve currency, is a defensive move by the Europeans to withstand these dollar shocks. And we are now facing another dollar shock, right? I mean, we are in a cycle of tightening, severe tightening, very, steep tightening. And we all knew that some things in the financial system would break. And so, from Europe's point of view, the feeling is that banks are better capitalized. But nonetheless, the feeling is that the laissez-faire instincts that you have in the United States and the Anglo-Saxon world in general will always bring turmoil or choppy waters, as we are having in this panel. So how to address this? Not easy. I remember Nicolas Sarkozy already in 2011 created a task force in the G20 to deal with the dollar and the possible de-dollarization of the international monetary system, a hot topic with some of the Indian students just over lunch. We were talking about that, right? That there is now a lot of talk about using other currencies. So this is difficult. And so in many ways you need to protect yourself against that. Some do it with capital controls. Some do it by having more sophisticated financial systems or a monetary union like the Europeans, and that worked for some things, not to others. But I think broadly speaking, I think we are in a phase where we want to have a financial system that needs to do a lot of things that we think are important and that have been covered in the panels previous to this one. On the digital transformation, on the energy transition, on stabilizing as well all the countries that are now in debt problems, on maybe reforming the multilateral development banks, and I'm sure Albert has some views on this. But I think these are issues that are broader than just the financial system. Right. But in general, I think, as was mentioned, there are a lot of parts of the financial system that are not very regulated, a lot of shadow banking, and that will bring us trouble. And so we need to rethink, are we going to be still looking at this as we like innovation and therefore we have a laissez-faire approach, or do we, in this new era, someone was saying it, right? Because, and I finish with this point, is the current interest rate cycle warranted? Because there is more and more research that points out that this is really an inflation generated by supply shocks and by corporate benefits margins, right? And that really kind of raising interest rates in this moment as we are doing it, perhaps it's not really what is needed. And so I think we need to have new tools, broader tools for a new era that demands to be quite specific on how to address all these challenges that we are facing.
Right. I think, Miguel, you raised a point, and I want to sort of take this to Bhanu. But let me first introduce Bhanu. N.R. Bhanumurthy, an old friend who's now at Base University, which is Dr. B.R. Ambedkar School of Economics, Base University. So Bhanu, there's a question. Let me sort of try and frame it. And then, of course, you can answer the question of what the G20 can do. But Miguel said there's some, talked about growth, and we know through a lot of financial literature, financial economics literature, that financial development is causal, has a causal relationship to economic development, so financial development. But the relationship between financial development and macroprudential regulation is a little ambiguous. I guess Miguel pointed to that. There could be trade-offs between laissez-faire and innovation and your regulation. So while that first order relationship is established, the second order is not. So, what can the G20, the same question to you, what do you think the G20 can do?
Yeah. Thank you, Rajat. First of all, I think we need to understand the North Atlantic crisis that we had in 2008 was largely because of the disconnect between the financial sector and the real sector. I think over a period of 14, 15 years, we still have not appreciated that gap between the financial sector and the real sector. And if you look at the whole literature, even after the 2008 crisis, even in academia also, there is not much of appreciation of the linkage between the financial sector as well as the fiscal. The fiscal policy and the financial markets, if you look at just Google, you don't find more than 2 references on the fiscal policy and the financial markets. And I think that disjoint or the disconnect seems to continue, and that's one of the reasons why we still have these episodes of the financial crisis getting into the real sector. And let me also take one step ahead of this discussion. If you look at the 2008 crisis and now, very few countries have actually learned that, lessons from those crises, and I think one of them is India in that sense. If you look at the post-global 2008 crisis and the recent crisis, I think India is doing extremely well compared to the other countries in the world, and we are the fastest growing large economy in the world. And the reason for this, again, it's not really been appreciated much in the discussions also, is because of a very good coordination between the fiscal policy and the monetary policies. And if you want to understand the benefits of having a coordination between the fiscal and monetary policies, you can compare the India's experience in post-2008, and you can compare experience in the recent period, where we had a perfect coordination between fiscal and monetary policies, and that's one of the reasons why we don't see inflationary pressure. I know Ashima is sitting here. She says it's not because of the domestic factors, but I think most of the inflation that we have right now is mostly imported. So in a way, even after almost 15% of fiscal stimulus that is being given in this country for 2 consecutive years or maybe 3 consecutive years, we still have inflation about 5 to 6%. So that shows the kind of coordination that we had between the fiscal and monetary policies. And I would like to say in front of Dr. Rakesh Mohan that fiscal monetary coordination is a public good. I think that is something that we need to be brought in. And I think G20 should bring a kind of a template, the kind of coordination that we need to have between the fiscal and monetary policies. And in terms of, can I add one more? Please do. Yeah, so when it comes to the banking crisis and all those things, and I think what is missing in the whole discussion in the G20 regarding the global financial crisis and others is that we still don't have a proper early warning signals. We have mechanism to predict heat waves 3 months before, but we cannot predict the banking crisis even after 3-4 weeks. I think that shows the kind of a weak framework that we have in terms of understanding the early warning signals in the financial markets. And in this whole episode of the fiscal, financial, and monetary policies, one important thing is the public debt. I think public debt is the crux of the fiscal monetary coordination. But unfortunately, if you Google again, you don't get one single number for one country when you talk about public debt to GDP ratio. In India, we have 3 or 4 numbers floating around. And we also need to understand the composition of the public debt. And I think that's where I come back to my point, which I raised it even the pre-India G20 presidency also, the role of domestic savings. I think that should be the focus of any country. They want to protect themselves from any kind of the spillovers. Maybe I'll come back to that, what is the role of domestic savings. But I think the countries that who have domestic savings, I think they're certainly protected from the spillover effects.
Thanks, Manu. I'll come back to you, Ashima, or do you want to say something immediately? No, why don't you had a point, right?
Yeah, I just felt I should come in here
please.
when you're talking about fiscal monetary coordination. There's a couple of just reactions to what has been said. First, this issue of regulations having costs. It is true that regulatory discretion, delay, etc., can raise costs, but macroprudential has that it's a fixed rule. It's some percentage of something that damps volatility. So it has minimum market distortion. Then about monetary fiscal coordination, I think that the key issue is how central banks aggravate these crises is when they overreact. In India, we overreacted to the global financial crisis and to the double deficits we had after that. And now it's the Fed which is overreacting. First too much stimulus and then too much tightening, which is creating, and since that is the reserve currency, it creates spillovers for the whole world. So in India, in this episode, we've managed very well, as Bhanu was saying, and the reason is partly the source was supply shocks, and we are used to supply shocks, and the fiscal action can act more credibly on that. But the rest of the world, for the first time, they were facing supply chain bottlenecks, and they followed traditional demand tightening policies that were an overreaction when there were supply restraints. But here we had the government come in with continual reform, supply side action, with tax cuts on oil and so on, which helped contain inflation and allowed the central bank to support growth, as well as inflation targeting is very important, but it should be flexible inflation targeting, where you take care, I think, this issue of, we have a rule in India, and I'm on the Monetary Policy Committee currently, that after 3 quarters, if inflation exceeds our tolerance band, we have to write to the government a letter. That's a discipline on. So we were looking at models. Our inflation had exceeded for 3 quarters, and we found that the UK, Bank of England, had been writing letters every 6 months because they have a fixed target, and each month when it's exceeded. Now you have these sort of supply shocks. So flexible inflation targeting really helps. If you have some time, you have a tolerance band, then you don't have to, like the Fed now is worrying that as long as inflation is above 2%, if they keep tightening. I mean, monetary policy acts with a lag, so that's a recipe for overreaction, which will create further problems for the financial sector and volatility for the rest of the world. I think that's
Thanks, Ashima. Overreaction is not only a feature of regulators, but also of markets. Remember Don Bush. So, Albert, I wanted to get you back in this discussion on the point that Miguel and Bhanu have both made about harmonization. And one of the things that happened, at least in India, I remember in 2013 and 14, was constantly the Central Bank of India, the Reserve Bank, was telling Ben Bernanke that you have to consider your spillover impacts. You can't just do it unilaterally. There are spillover impacts on the rest of the world, especially emerging markets. Asset bubbles are created, and you have to do that. And the response was, well, we have to worry about domestic policy before we do worry about international policy. And so Bhanu raised the issue of harmonization. Miguel raised the issue of multilateral banks and the reform of the multilateral institutions. So are you sort of optimistic about harmonization and reform of multilateral institutions? You have to be here.
I have to be optimistic if you phrase the question that way. But I wanted to give some examples of some of the regional cooperation initiatives in ASEAN +3 that are also ways to deal with the dollar shocks, right? So the first is that after really the Asian financial crisis, but especially the global financial crisis, there was an initiative to develop local currency bond markets, which have really grown almost exponentially, so that many countries in the region have, in Asia as a whole, the bond market volume is on the similar level as Europe or the US, right? Whereas before it was, at the time of the Asian financial crisis, it was almost all dominated by dollar assets. And so that really helps insulate these economies from shocks related to dollar exchange rates. And the second is that after the global financial crisis, ASEAN +3 means adding Japan, Korea, and China, set up the Chiang Mai Initiative multilateralization, which is a regional framework of currency swaps. And it's capitalized now at, there are commitments of up to $240 billion, which is, compared to the European Stability Mechanism, is about $700 billion. And this also provides additional financial relief in addition to whatever you can get from the IMF in times of financial instability. I was at the ASEAN +3 meetings a couple of weeks ago, and they keep talking about how can we improve this mechanism? Maybe because right now it's all commitments. There's no paid-in capital, so there's discussion of doing that. There's the mechanism has never been used to date, so there's a discussion about how maybe we need to understand why it hasn't been used, or if there's some things that are preventing countries from using it. But it's really just incremental, making these mechanisms more effective. Last thing I wanted to say is related to this idea of financial innovation versus regulation, and it's also related to your discussion of the old debates about capital market liberalization. So at the ASEAN +3 meetings this time, there was a discussion saying we should do more to promote financial integration across countries in terms of payment systems so that money can move much easier across countries in the region.
Right.
But you can imagine that in the context of a banking crisis, that could really lead to a lot of flight of money across borders.
Right.
If there's some loss of confidence in a bank. And controlling the contagion across borders becomes a lot hard. The issues are much more complicated because you could have flight to countries that seem to have a better budget balance,
right,
or better debt sustainability. But at the same time, it's efficient, right? It promotes development. Financial development promotes economic development. So if you do that, then you really need to think about the regulatory side, right, and the prudential regularization, or else you decide it's not worth it, right?
Yeah.
But I think we would like to think we go forward with development enhancing, and then we figure out how to regulate. Okay. So I'll stop there.
Thanks, Albert. Miguel, wanted to sort of ask you a question. I mean, Ashima already addressed the next two questions I had, and I wanted to put those to you in the context, again, of Europe, is the role of regulators and the role of central banks, especially in the European context, the role of a European central bank. What do you think would be the role of a European central bank in stemming such a crisis?
Well, as you know, after the global financial crisis and the euro crisis that we had just afterward, the central banks were seen as the saviors of the moment. Fiscal policy in the United States was in deadlock. In Europe, there was certain tightening or for some austerity that didn't help. And somehow the central bank became, in the European institutional context, perhaps the most powerful institution. Certainly the most federal institution in a confederal structure, and that gave it a lot of power. And then there was the debate that even the central bank should be, moving into climate change related issues and green finance and all of that, right? Then there was a strategic review of what the central bank should do. And at some point, people were saying, we cannot put too much, too many expectations, too much. And so I think the latest paper that came out of the European Central Bank, it's actually curious, which is a paper on Europe strategic autonomy. So there you see how central banking is moving as well into geopolitical territory. What does, European strategic autonomy mean for monetary policy in Europe in a context of great power rivalry between the United States and China that will affect us all in many ways, right? And now I think there's more heterodox thinking. As I said, I mean, some people like Isabella Weber, they're questioning whether we should tackle, and Ashima's point, tackle this inflation we are seeing right now with the traditional tools of interest rate hikes, and that perhaps more targeted tools, fiscal tools, price controls even, that were heresy. Isabella Weber and Paul Krugman had this big discussion a few months ago on this, and it seems that the ECB's latest research shows that it is really profit margins of companies that are really pushing inflation up. So I think central banks are, in a way, adapting to a new world, adapting to a world that I think has three structural features that will be with us for decades. great power rivalry, digital transition, and energy transition that will require more public intervention. And I think that's why, you know, the discussion in India here, and I'm quite impressed about all this, you know, development of public digital infrastructure. It's, I think, very interesting. So we are now debating whether we will have a digital euro, what to do, you know, so we have not really even discussed this, which is another matter that the G20 will discuss.
I was going to ask Bhanu about this.
Well, so I think it's all interlinked, isn't it? I mean,
yes.
And there, will we have a period where we have even more competition and rivalry between currencies, or do we have more cooperation and interoperability and better monetary policy in combination of fiscal policy in the future, thanks to having digital sovereign currencies?
Right. So, you know, Bhanu, you wanted to talk about the debt issue. Please do. But I also, this is a segue to the point that Miguel is making. The first global financial crisis, I mean, the recent one, banks were responsible. This time it's banks, but banks that were not regulated. And then we'll have digital currency. So we'll get out of this mess, probably, with more regulation or more bailing out or more moral hazard being created. But then there is another source, which is the digital, which could also create manias, panics, and crises, right? And the rules of the game then will perhaps have to be different from what the rules of the game are now. So your thoughts on this before I open it up?
I think, thank God we have Reserve Bank of India. So I think we are in the safe hands. Each and every crisis, we have central bank rescuing us. So I know that what you're asking is about the digital transaction, the kind of risk that is going to pose. I think we have much better regulator in a way compared to other countries. I think it's a black box at the moment, but the way the central bank is allowing all these transactions, in a phased manner, shows that I think they are definitely under control in terms of the risk that is coming from the digital currencies. And I think it is the finance ministry that created some confusion regarding the whole crypto and digital currency issues. And right now, central bank is actually piloting this whole digital currency, and it is still not been scaled up. So we look forward for some more data from that whole exercise.
Okay. Before I open it up to everybody, I know Rakesh has views on the digital currency, but only if you wish to. But before I sort of open up to the audience and the students sitting there, we have a special guest who's going to be a discussant, and I won't pose a question. I'll just sort of ask Gulbin Sahin Beglu. If I mispronounce your name, I apologize. But Gulbin is easy to pronounce, so Gulbin.
Yeah, Gulbin, yeah.
Gulbin,
Yeah.
who's the Center Director for the Economic Data Analysis Center at TEPAV, Turkey, which is a well-known think tank, which anchored the T20 in Turkish presidency.
Okay.
So Gulbin, your thoughts on
My
what
thoughts.
we've discussed.
Thank you, Raja. You mentioned about historian economist. I'm a central banker, old central banker. So I worked 30 years before I joined TEPAV. And I witnessed many crises. Every 7 years, Turkey comes into crisis. So that's why they wanted me to share, not discussionship, but my remarks on the current turmoil, let's say, and give a central bank perspective. I want to, maybe some of my remarks are echoing our distinguished panelists. It's very important to understand why it happened, to address right policies and to seeing the gaps, actually. So the real cause of the problem is really mismanagement of the risks, as Mr. Park mentioned, and weak supervision. So we see there's a big mismatch. the asset side of SVB is totally tech companies' deposits, and they are 94% uninsured, and the liability side is 40% government bonds and mostly US bonds, and they are on face value, and there is a interest rate and maturity mismatch of the balance sheet. It was very clear unsupervised balance sheets. And on top of that, the balance sheet increased 300 times in four years, tripled. So that is supervision 101, right? If they go this pace, that means that something is wrong there. And it is the supervision and regulation pace doesn't catch up. So it should be supervised. So there's an underlook on that. On the central bank perspective, the central banks did their bit right, because we had high inflation and central banks increased the rates to combat with the price stability, to achieve price stability. But this also underlined the condition for effective monetary policy. It is the sound banking system. So existence of the sound bank system is a must to have a proper, effective monetary policy. And for the sound monetary policy, sound banking system, it is also proved that it should be supervised, regulated bank by bank. And the current Basel III system accords is applicable to large banks. So it depends on the country's approach, right? And medium banks should be covered. So I want to echo now Ashima's conclusion. We had to come up with minimum set of regulations. So that may be a call for our G20 statements in TF1, for example, that we can summarize from this panel. So it is a combination of not only monetary fiscal policies, but macroprudential policies as well. It is three actors that should be coordinated. So this is an important lesson I think we got. And Basel III is also missing. So in today's world, it is not a bank run, it's a bank sprint. It happens a day, not a day, in hours' time. So the Basel III Accord doesn't catch up today's realities. So that also showed that to us. I think, and I also want to, again, comes to Ashima's remarks. You say that as an MPC member, we are overreacting. And underreacting is a bad thing, and Turkey proved that. Current central bank policies, we have minus 37% of interest rate now. And we have minus 60 billion reserves now. So really, it shouldn't be underreacting, it shouldn't be overreacting. And the balance is the art of central bank. So that's really, I wish you good luck, Ashima. Really, it is really an art. I also want to mention that Central Bank of Turkey's current strategy now. We are doing the reverse of inflation targeting framework now. And also, before conclude, just another experience I want to share. We had two crises. One is 2001, a big financial crisis. And we have 2008. One is crisis, one is turmoil. And the difference was the sound banking system. In 2001, we had a bank crash, and we had 30% of GDP cost of covering this damage. But it was, as Sherpa Kant mentioned, the crisis turned out to be an opportunity. We established independent banking regulation body. We changed the central bank law. We promoted independence. So, and in 2008, we had the sound banking system. So that's why we had a turmoil, not a crisis. So that really saves you central banks and your country as well. So that's it. Thank you.
Thank you, Wilbin. I'm just going to make a comment because this echoes something that was said by Bhanu, and then I'll go to a question. I like the analogy, I mean the phrase that you used to describe a bank run, a bank sprint, and I was thinking that the rate at which it grew, it was probably a bank bolt, pun unintended. But, you know, if this was happening, and if you see that film called Inside Job, what happened in Jackson Hole, people saw it coming, but they looked the other way, especially in the United States. It was sort of the sort of macroeconomic indicators, like you were saying, if your credit is expanding at such a fast rate, your balance sheets are growing at such a fast rate, you would stop and think. And the same thing was happening in the Jackson Hole conference. This was just pre-financial crisis, depicted fairly well in that film, Inside Job. And as Bhanu said, we've been unable to predict these crises, despite the early warning systems, in some sense, being there. Okay, so question to you. Yes, and students, please be ready with your questions as well. I'll take a couple of questions together so that we make full use of our 10 minutes. Please note the questions.
Question for the panel. Vera from Brazil. Look, nobody talks about China. China is the biggest exporter of the world, becoming the biggest importer of the world, lending money a lot for developing countries, and with a huge reserve. Can you panelists envisage China as the second renminbi, as a second international currency, or not?
Okay. Next question there. Yes, please. Please introduce yourself, and short, very short questions. Who'll take this question? Anybody want to take this? China, you'll take. Albert, okay.
Good afternoon. This is Sekhon from a private equity firm from New York. I would like to actually, ask a question from an entrepreneur or industrialist perspective. When we look into the opportunity in the market today, with the, advent of exponential technologies, if I put all the exponential technologies in every sector, the value which I can realize runs into trillions. If the government fails to recognize this opportunity, does not push growth, depends only on monetary policies, that stifles our growth. So we are trying to understand why monetary policy should stifle our growth. If the government, say for example, we are blaming Trump for what happened in the US. Okay. I'm from US. I don't think so, because during Trump, we had economic growth happening. Okay. What's happening in India right now, we are pushing growth, yes, right? That's probably taking care of this.
Thanks, yeah. Thanks. So Ashima, you'll take that question. And yes, a student back then I'll go back to the panelists and we'll do perhaps another round. And please introduce yourself.
My name is Ansh Sharma. I'm a law student. So we saw with the Credit Suisse bank collapse, so some amount of deposits were secured while the investors were left out to dry, and the Saudi bank lost $1 billion. Don't you think that lifts the trust out of the banking system and makes people hesitant to invest in the same during such periods? Okay. And is there any regulatory mechanism that we can introduce to solve the same?
Any regulatory mechanism to enforce trust? Sorry. Albert, the first question on China, then I'll go to renminbi.
I think the use of the renminbi will increase, but I don't think it's going to become a widely used reserve currency for quite a while. And the reason is that China, again, made this decision to keep its capital account closed, again, worrying about financial stability risk. And most transactions in the world are financial transactions, not trade transactions. The volume is infinitely greater. And if you can't really move money in and out of China easily, you're going to hesitate to want to hold large amounts of renminbi. So I think that's a big challenge. Of course, China has been slowly liberalizing its it's opening it up step by step, and it says it's committed to moving further, but still it seems very deliberate and very far from really liberalizing the capital account.
Miguel, before I sort of ask Ashima to answer the second question, just going on from this, if you think you have the answer or you've thought about this, is that I've heard there's a lot of back-channel diplomacy going on, sort of by China, to sort of the soft power that US was able to create in the early part of the last century. China is similarly doing some back-channel diplomacy to ensure that renminbi does become an international currency. Any comments on that?
Well, I just finished a paper on renminbi internationalization, and I play with this metaphor that this is a Chinese saying that you need to build the road to make business and to make a place rich. So I use kind of this metaphor to explain that China has been building 3 motorways. One is the bilateral swap agreements, and latest research shows that these bilateral swap agreements in terms of debt restructuring, etc., have been quite, not only debt restructuring, but providing emergency liquidity for certain countries has been key. The second is the new interbank payment system that they are building, have been building, and Russia is now apparently using as well to, circumvent the sanctions, and more gradually only. It's so we can call it motorways, but not much traffic in them, right? Not many cars on those motorways yet. And then the third one is the e-yuan, right? The e-yuan, that they are supposed to be the ones more advanced in terms of the digital sovereign currency, and whether they will at some point internationalize that, and so, etc. So it's in the making. But I think, yes, there's some research showing that, for example, on the bilateral swap agreements, etc., that the countries that have signed the Belt and Road Initiative have been supported more by China. So there is all sorts of diplomatic channels here that China is using. Of course, it is a more, command and control rather than a liberal approach, and therefore, I think it's going to be a very gradual, long march, if you want to use another Chinese metaphor, in terms of the internationalization of the renminbi.
Yeah, a journey of 1,000 steps starts with a single one, or something like that, right? Yeah. Ashima, your
yeah, if
answer.
I can just briefly on this multiple currency, I think that more than renminbi becoming the reserve currency, the payment system innovations are pointing towards more central bank cross-border transactions. And this can net out a lot of current transactions that take place, and most important, impose some discipline on the dollar, on US policy, which is very, very important. There's no competition, you do
That's
all
right.
sorts of irresponsible things. And there are 2 other factors that should make the US more responsible, which is that now the rest of the world or emerging markets are really large in terms of incomes. Even if they're only concerned about their domestic system, there is a huge feedback and spillover on their own growth. And second, we are seeing that there are huge risks to the financial sector. So that spillover is also there. So therefore, they have some motivation to improve policies, and I'm sure they could, as part of G20, they can move towards, G20 can push them and achieve some sort of agreement on regulation, etc. So coming to that issue, the equity issue, about monetary policy stifling growth. I mean, if the real interest rate is negative, how is it stifling growth in the US? It's stimulative. So the key is, as I said, for monetary policy to avoid overreaction or underreaction, as we heard about Turkey. And that can, keep things smooth, as well as some minimal set of regulations. So, for credit squeeze, again, some sort of, when equity holders lose money, then they are motivated to impose discipline. That's the way market discipline works. So you can't bail out everyone. Right. You have to bail out depositors, because now they can take out money in a trice in the digital economy and can really spread. So you need some people to be left holding the can. You can't rescue everyone. Then where does the discipline come from? But market discipline alone is not enough. You need some regulation, supervision, etc., as well as central bank sort of balanced action. Thank you.
Thank you. Bhanu, do you want to talk about regulation and trust?
Yeah, just to add to what Ashima said. In fact, the student asked a very interesting question. But I want to add to that. If you look at this Silicon Valley Bank, just before it get collapsed, 1 week before, the London economist says this is one of the top 5 banks in the US.
Right.
Okay, so it boils down to the issue of the regulation.
Right.
And I think some of the things that we really don't discuss in this kind of forum is the role of auditing. You know, I mean, I think there is a need for some kind of a regulation or a common framework when it comes to auditing of these firms and the banking sector, and also in terms of the rating.
Right.
Right. I mean, you know how the rating agencies punish India all the time. But we
But
know
not
that
Greece.
But they know if you look at US, they are going to default on the public debt, right?
That's right.
So
yes.
but they still get higher ratings
That's
compared
right.
to India. So I
That's
think
right.
these are the 2 or 3 issues that needs to be brought.
I think conflict of interest, of course, is a major issue. And I remember Satyam, which collapsed in India, was given the Golden Peacock Award for top corporate governance a week before it collapsed. I don't know if you remember that. Yeah, we are running out of time, but I really wanted to have another round of questions, and so Samir will allow some flexibility. Yes, please. Yes, lady, yes, please. Please. Yes, you are. Okay.
Hi, I'm Dia. I'm an intern with ORF. And my question is, we spoke about LCS agreements gaining prominence even in Asia. It was promoted by the Indonesian G20 presidency as well. But even the dollar dominance has imposed costs for the US as well internally. Their exports have become expensive. Right-wing politics have called for deficit reduction. Do you believe that the benefits of dollar dominance would continue to outweigh the costs for the US, or would there be some move internally because of politics or economics away from using the dollar as an international
Okay,
currency?
thank you.
Thanks.
Thanks. Is there any other question? Nobody? You're all... Yes, please.
So I'll repeat the question which I asked in the previous panel. Can we develop some innovation funding for G20 and all the developing countries? Because a lot of innovations are also required, especially in green technology, etc. So broader innovation